All right. We are live Q&A. Little technical difficulties. I pressed that 30-second countdown. I never pressed go live. So sorry, you didn't get the 30-second countdown, but here we are. We're live every Monday, 6 p.m. Pacific Standard Time, live Q&A with a mortgage broker who's going to shoot straight with you. Going to give you straight, honest answers. Any of your mortgage questions, any of your real estate questions, any of your housing market questions. I've got some exciting stuff to start with today before we get a few dozen people live with enough questions to kind of keep this thing going. I just want to share with you this last weekend, I was at the largest mortgage conference for mortgage brokers of the year, AIM Fuse 2021 in Vegas, 3,000 plus mortgage brokers and lots of good stuff. Lots and lots of good conversations with mortgage brokers from around the country. What I would love to share with you here, what is my video that's going to be released tomorrow, is the future of mortgage and some exciting news from the largest wholesale lender in the country, United Wholesale Mortgage, something they've been working on for 15 to 18 months. Technology that's going to basically do the initial underwrite on loan files, which is super cool. And if you know United Wholesale Mortgage, then you know that they are not going to come out with a piece of software. They're not going to come out with something that is, not the leader, not the best. And so hearing it straight from them, 15 to 18 months in development, it is a really robust artificial intelligence where, I'll explain it to you here. It's in my video tomorrow. Basically, you upload a batch of documents and the technology is going to be data extraction. It's going to be doc recognition. It's going to be smart technology. It says identification, cool. Pay stubs, cool. W-2s, looks good. It's going to extract all the data from it. It's going to sort it just like a human would do if a human was underwriting a file. And then it's going to issue an approval. And, it's able to do a bunch of stuff that an underwriter has historically done, right? Look at W-2s and say, this person makes $84.23 a month. That goes into that bucket. Look at a credit report. This person has this in debt, that in debt, right? And do everything that initial underwriters do. Here's the key. It's going to do it in 11 minutes. It's going to do it in 12 minutes. It's not going to be a 1 day, 2 day process. And a lot of the lenders that I send business to, United Wholesale Mortgage being at the very top of it, are underwriting files in hours. They're underwriting files in even the other lenders that aren't as fast, 1 day or 2 days. And so it doesn't take a long time, but we're talking 11 minutes. And when we're talking about it happening that fast, what it provides for the consumer, for the real estate agent, is certainty. When a mortgage broker like myself and my team get a file and we're able to do that, and within 10, 15 minutes, tell the real estate agent and tell the consumer, you're good. We've got a conditional approval. We've read that conditional approval, getting a profit and loss from you, getting a letter of explanation about a past address, getting these few items that are needed on this conditional approval are easy things. You're going to be good to go. So I think that it's exciting, and it's just the continued story we're likely to hear over the next few years. This meshing of technology and humans within tons of industries, right? Not just mortgage, within a ton of different industries. So that's that. If you have any questions on that, feel free to reach out to me and the team. Feel free to ping us, matt@mattthemortgageguy.com. We are happy to help. And that is live today, September 27th. I've already got feedback from mortgage broker friends that it's working well, working within that 15-minute time frame as promised. So exciting stuff. And there's just going to be more and more of that, right? There's going to be more and more technology where it used to be 3 weeks into a loan process, you'd say, well, based on how this S Corp income is calculated, no, there's computers now that can analyze that stuff and spit out. We reviewed the last 2 years of your tax returns, your business tax returns, 277 pages of them. And here's what you have for income per month. All right, let's jump into some questions and see where it leads us. It's always It's always fun. All right. Yep. Once I started doing that, Joey, I just couldn't stop. It's just natural. It just feels right. Zeta, thanks for joining. I truly appreciate the support. Another familiar face, Kevin Hawthorne. Thanks for joining from Florida. Appreciate you. Bradley Coleman. Do you know anyone who's doing foreign national programs? A Canadian that wants to buy in the U.S. You know what? There's definitely lenders that are doing foreign national stuff. I'm not familiar with it, so I won't pretend like I am. But I feel like, as a mortgage broker, I've got 40 to 50 lenders we're signed up with, and then I've got another 40 that want us to sign up. I feel like I've got emails from account executives, foreign national program, and it's not in my inbox long enough for me to read it. It's deleted it on with it because I'm a firm believer in being really good at a specific lane and just hammering down in that lane and doing right by folks there. And if you're construction loan, if you're down payment assistance, if you're foreign national, if you're just this stuff that I don't see that often and do a lot of work in, I truly believe you're best served by somebody who does. So I'm not the person for that, but I believe it's probably out there. All right, Leroy, what minimum monthly savings is your cutoff for a refi? This is a great question. This is a really good question. And the answer for it, Leroy, depends on a couple different things. And here's what I would tell you. If you told me this and you said, how much would I have to save every month for a refinance to make sense? That's essentially what you're asking, right? Well, if you're saving $200 a month, but you plan on moving in 6 months, then that doesn't make sense, right? Because one, you're not going to bake in the cost of a refi when you're moving in 6 months, kind of irrelevant of how much you're saving. But you're not gonna get to the point where it's gonna break even. So here's the math that I generally do with folks for folks. If we're doing a standard refinance and somebody's not trying to buy down the rate, they just want the rate that's not costing any points, which is generally, like, more often than not, the best deal, right? Then all you've got as far as third-party fees go is some title fees and an appraisal if needed. For lots of loans we're doing, there's nothing in box A. There's no lender fees. And that's kind of how we've set it up going forward, is that's our plan, is no lender fees. So let's call it like $2,000 in total fees, title, appraisal. And if you're going to save $200 a month, it breaks even in 10 months, pays for itself, right? And here's a little warning for folks. I'm seeing a lot of this nowadays. The lender's doing one of two things when they try to sell you on a refinance. They're either giving you a really good rate and it's very expensive. And some people are like, oh my gosh, 2.375. Sweet rate on a 30-year fixed. Not realizing that $19,000 is getting baked into their loan. Terrible idea. So don't do that. Also, don't do the opposite, which people say, listen, I'm going to a lender. They're telling me no fees, no cost refi. Oh yeah. That no cost refi is at 3.25. That's the other end of the spectrum. Well, you're taking a high rate. If you're going to be in this house for 4, 5, 8, 10 years, don't take a rate that high. Somewhere in between, where there's a little bit of cost, in the case that I'm talking about, $2,000. If we're lowering your rate down to 2.8, you're saving $200 a month, and there's $2,000 being baked in, paying for itself within 10 months. That's going to make sense. And here's where talking to a trusted advisor makes all the difference in the world. Literally had a conversation today where the guy was being shown a 2.25 on a 30-year fixed. Never, ever am I going to recommend paying $21,000 in points to go to a 2.25. I didn't do the math on that specific deal. I might still have this rate sheet up. But the $21,000 in costs for his credit score, for that loan amount, his credit score and all that, would have saved him, looks like, about $160 between that and the rate that cost $0. And so 160 into 21,000 131 month break even. 11 years. Got to be in that loan for 11 years for that 2.25 makes sense. And that's why I told him, I said, it just frustrates the crap out of me that somebody's even showing you the 2.25, allowing you to maybe make that terrible decision. So don't do that. So yeah, find someone, Leroy, that's going to show you a good combo of great rate and low cost. Low cost doesn't mean no cost, because a lot of the no cost stuff I see is crap. Don't take a 3.25 just because it's no cost. And rates are different, whether it's cash out, whether it's single family and condo, whether it's 75% loan to value or it's 60%. And so, I can't quote a specific rate because 3.25 might be terrible on something and great on something else, and you might be aiming for 2.75 on your deal, but somebody else is 2.99 is good because it's cash out, 75% LTV or something like that. So anyhow, long-winded way of saying it depends, but short answer is just do the break-even analysis. Save 200, cost me 2,000, 10-month break-even. All right, Zeta, you want to know if bidding wars are over for now, or will they rear their ugly heads in 2022? That's a good question, because in some places they're still going on. In some places, I've got people that are putting in offers on houses, waiving all the contingencies, going above ask, and not getting it. Oh my gosh. You talk about frustrating. I got some clients who are extremely frustrated, and they're making the right offers. They're well qualified. They've got money to, bridge an appraisal gap. They're doing everything right. Only thing that I'm seeing with some of these clients who aren't getting offers accepted is they're going after the stuff that's the nicest, stuff that everybody loves. Hence the offers, hence getting beat out, even when you're offering a great offer. So they're not necessarily over. They've definitely, subsided. Some of the ugly ducklings are sitting, but it'll be interesting to see what happens, Zeta, spring of 2022, when buyers are out in full force and that buyer pool grows. If there hasn't been a little bit of a bump in our supply, we might be in trouble. We might have another really, really competitive spring season. It's going to depend on rates. It's going to depend on lots of different things. And really, for me, I think like 6 months out, who in the heck knows what's going to be going on? If the Fed starts tapering in November, like they've talked about, and interest rates go up, that might quell demand. And so there might be less, buyers out there, but it's anyone's guess. All right, Joe, we welcome back from Vegas. Head there for a bachelor party a week from Friday. Have fun. Be safe. It's a weird town. I don't know what else way to put it. I don't drink or party, so I'm walking around sober, just looking at people, wondering what the heck is going on. If I'm in some sort of like alternate universe where everybody's, I don't know. That was just when I was outside with the freaks and the weirdos. When I was inside this conference, it was a bunch of really good stuff going on, from the speakers that were there to the conversations in the hallway to the little, panels and dinners we had and whatnot. It was really, really great event for me. So I won't knock Vegas and how weird of a town it is, because I really did enjoy it because of the people that were at this conference. Oh, your bachelor party. All right. Be safe, bro. Have fun. Vegas. You just want anything that's home possible. Anything that's home possible. Other thing you're getting pumped about is that 95%. If anybody missed it, 95% loan to value. I believe November 15th or 17th. One of those two dates is the date for when the guideline changes. If you're buying an owner occupied 2 to 4 unit, that is going from a 15% minimum down to a 5% minimum down. Only thing to think about is it's a home possible program, meaning you have to fall within certain guidelines. You got to qualify for that program. It's just not for everybody. You got to make 80% or less of the area median income. Near me, it's 72 grand. I was talking to somebody from out of state that said, oh, maybe it was Minnesota. Mortgage broker from Minnesota was saying you could make up to 90,000 in some of the counties he worked in. So anyhow, look into that if you're thinking about buying an owner occupied 2 to 4 unit. And it's going to be pretty cool to be able to do a 5% down conventional, right? Jeanette 46, hiya, I'm new here. Go ahead and join. Happy to help. I was going to tell you to ask a question, but then I scrolled down a little bit and I saw it. So happy to help you. And down here, you have 5 months remaining in your chapter 13. Do you think it'll be hard to refinance my house once I'm discharged? No, you'll have options on refinance, and I guess it'll be a matter of a few different things. One of them is how much it affected your credit, but certainly, the chapter 13 is not going to make it impossible for you to refinance. So ping us, matt@mattthemortgageguy.com, shoot us an email. It's not very easy, but sometimes, an active chapter 13, if you get permission from the trustee, you're able to refinance. And so we'd be happy to look into it for you. We'd be happy to discuss your specific scenario, what you're looking to do, and just kind of see what the current mortgage is and how we can help. If nothing else, put together a game plan, right? That's always my advice to folks. If you're thinking about buying, if you're thinking about refinancing and it's not today or next week, but it's a month, 3 months, 6 months out, it never hurts to plan, especially when it comes to a big purchase like real estate or a refinance of multiple hundreds of thousands of dollars. Get in touch with somebody who can help you out and give you good advice. All right, Leroy, how many years is too many for buying down points? This is a good question, and I'll clarify it for everybody. Buying down points is basically paying up front to lower the interest rate. Whether it's a refinance or a purchase, it's the same. And how that works is, let's call 3% an interest rate for a specific scenario that doesn't cost anything. And for 1 point, which is 1% of the loan amount, you can get a 2.75. And so a $300,000 loan, it would be $3,000 in cost. It would go to 2.75. Or for 2 points, you can go down to 2.5%. And that's a $6,000 cost. What you want to think about before you go out and spend that $6,000 up front is, what's the payment difference between the rate that I'm paying for and the rate I can get for free? And if that difference is $100 and it costs you $6,000 up front to get it, then you can do the math and say, technically, it's going to take 60 months, 5 years to break even, because I'm paying $6,000 up front, but I'm saving $100 per month. The only problem with that, or the only thing or one of the things to consider, is that $100 today and $100 in 2026, probably not the same purchasing power. 2026. When I say probably not, I'm saying like shit in one hand and hope in the other and see which one fills up first. Like, very unlikely, right? Transitory inflation and all these silly things that, folks say. Inflation is here. Gas is more expensive. Every single thing that I see on a daily basis is more expensive. I don't think that just magically goes away. So I don't like to see more than like a 3 or 4 year break even, Leroy. So in that scenario, $100 a month saved, $6,000 up front, I would say it doesn't make sense for a lot of people. And some people say, well, I plan on being in this house for at least 10 years. Well, do you plan on being in the same mortgage for 10 years? Because the data kind of shows that every 3 to 5, you're going to be in a new mortgage, whether that's shortening the term, lengthening the term, pulling cash out, selling the house. Like, people just don't stay in the same mortgage for 10, 12, 15 years. But maybe you are. Maybe you're like, you know what? I'm retiring in 2 years. I'm going to get a great mortgage. I'm going to set it. I'm going to forget it. I want to have that fixed payment in retirement. I'm not going to touch it. Then maybe it makes sense, right? And that's why every situation is unique. But just be careful. Don't pay too much, because here's what happens. You pay 3 points and you get an interest rate that you get to brag about at work, where, you paid 3 points on a $400,000 loan. So you paid $12,000 up front. You rolled it in and you're saving whatever you're saving at that smoking low rate. And, you paid, let's call it 3 points for 2.375 on a 30-year. Well, 3.5 years from now, something happens. Something with family, something with job, something with the economy, something with your state. You sell and you move. That $12,000 is sunk, right? It's gone. You can't take that 2.375 with you. If you move houses, if you need to refinance because some family emergency, got to pull $100,000 out. Like, you just have to. So that's my advice, is I wouldn't do it if it was more than like a 3-year break even kind of rule of thumb. But, think about your specific scenario and talk it through with somebody who knows what they're talking about and cares. I have situations all the time where somebody calls me, they don't know. And initially I don't know either. And I said, let's talk about it. Talk about the pros, the cons, the do's, the don'ts, the what ifs, your future, mortgage rates, future, your city, your job, all of it. And then after 7 minutes, 11 minutes, yeah, I think that's the right rate. And bam, we solved it. Did you get any clarification regarding my question about it last week? It's funny, Joey. I can't believe I remember your question. I've got memory of, if an elephant remembers everything, I'm like the opposite of an elephant. I'm an anti-elephant. I wrote down your question and I asked a few people. One person said yes, one person said no. So obviously I got to ask some more people. And your question, if I remember it correctly, was, do we have to include the rental income with your regular income when qualifying you for Home Possible? So if you got to make less than $72,000 to qualify, does that include the rental income you can use? It can't be the case. It cannot be. I'm just saying right now, it can't be. But I got to be honest with you. I didn't, for 100% certain, find out for sure. So this is my promise, Joey. I'm going to send that email tonight. And we've got 6 weeks till it comes out. So you'll be just fine. Don't you worry. You come back from Vegas, you ask me, I'll have the answer for you. All right, Liz. Thanks for joining. Thanks for the questions. I appreciate you being here. Does paying cash over appraised value give you equity of that amount, or is it nothing? Just offered $15K cash over ask, and we're the backup offer. Well, it doesn't necessarily give you anything, but equity really only comes into play when there's an event, right? Like, let's say you buy this house for $515,000 and it was listed at 500. And it comes back and it gets appraised at 500. And so you're paying that $15,000 gap because that's what you agreed for. Like, that's what you offered. You close on the house, you're in the house, it appraised for 500. You paid 515, and that's what goes on the record and really kind of sets a comp because you paid 515 for it. Other stuff around that sells. What's it going to appraise for in 6 months, a year? I don't know, but I think that 515 sale price is going to mean something to the future value that might drag up what you appraise for at 500, if that makes any sense. So, at the time you purchase it, the appraised value is that one appraiser's opinion of value based on the comps they see at that present time, right? And so they haven't seen the comp of your house selling at 515 and the house that sells down the street that can use your comp of 515, that might pull that value up a little bit. So this is actually a good question. And I know that my buddy Ryan Lundquist was going to be listening tonight. Sometimes when he's working away on his appraisals, he'll have his buddy Matt the Mortgage Guy on in the background. I'd love to hear his take on this because it's a really good question, just from a buyer's perspective. And what I'll tell you, irrelevant of the appraised value question, is if in your scenario it's listed for 500, you're offering to pay 515. It might appraise at 515. You don't know. It might appraise at 490, but your contract says I'm willing to pay up to $15,000 above whatever it appraises at. If it appraises at 490, I'll pay 505. If it appraises at 500, I'll pay 515. If you're comfortable doing that, and you know you're going to stay in this house long-term we'll call 5 or more years, then, and you have the money to do it, right? Like you're able to either shift the loan structure or pay the extra $15,000 out of pocket, then I wouldn't get too caught up in appraised value. You know, some of these people that are paying $100,000 above asking price, and willing to pay the appraisal gap there, that might be scary. But like 15,000, if it's a owner occupied house you plan on living in long term and you get into good financing terms, I don't think it's really like anything folks should be worried about. You know, some people get really stressed about it or whatnot. So I don't know. Hopefully that answered your question. I started rambling, so I better move on. Natural. Thanks for joining. Good question. Are you seeing appraisals taking a while right now? Yes. And I got something to say about it. Appraisals are taking a long time, and it's a function of a lot of demand and not enough supply of appraisers. And it's been a problem that continues to get worse. And, you know, to get your license as an appraiser, I don't know all the details of it, but from what I understand, it's hard. You've got to work as an apprentice and do a lot of hours as an apprentice. Right now, appraisers are so busy, they can't even take on apprentices to be able to get them those, requirements, fulfillments met so that they can become appraisers. And so it's an issue. The good news is that there's some stuff being done, namely UWM, a great lending partner of ours, is doing something called Appraisal Direct, where they're creating their own appraisal panel, paying the appraiser every single dime that the order generates and paying them the next day. And well, the reason I know this is going to help, one, because it's been piloted for a month and it's been extremely successful, but two, part of the problem is when they created appraisal management companies, they said, we don't want the lender and the appraiser talking. The lender's going to try to manipulate what the appraiser does as far as value goes, and that's what caused problems in the past. So they put a layer in between. The problem is that layer in between started to put a little bit too much fluff in and said, client pays $650, we'll pay the appraiser $425. We'll keep $225 for ourselves. We assigned the deal. We brought the deal in. We acted as the middleman between the lender and the appraiser. Appraisers didn't necessarily like this because it was $225 that, didn't go to them, right? And trust me, I've seen and done loans for appraisers who work for a bunch of different AMCs. These AMCs take a big rip. United Wholesale Mortgage said no more rip, 100% to the appraiser. And they're a huge lender that can do that. They can absorb $12 or $15 million a year to have 125 people working on this and 125 people making sure ordered. All right, let's get it assigned to the next hour. All right, now it's assigned. It's due back in 9 days. Reach out to the appraiser. Make sure this is the date it's due. Let's go. Constant, right? And systems in place to make sure appraisers are held accountable. Appraisers are getting the orders back quick. In return, here you go, Mr. Appraiser, $650 appraisal. You get the whole thing. You completed the thing yesterday. Here's your pay. Don't wait 4 to 6 weeks for the AMC to get their books right and send you money next day. And from what I've heard, another question from my buddy Ryan Lundquist is, some appraisers who stopped doing business with AMCs because they said, you know what, I don't want to deal with that. I don't want that middleman cutting out, a third of my check, are coming back and saying, oh, if it's all coming to me, I'm back in the game. I was out because I wasn't going to mess with those AMCs. I'm just doing private appraisals. Now that UWM's got this program, let's see if some great appraisers come back into the mix. So it'll be interesting to see. But Nevada, broker friends of mine, $1,000 rush every single order to get them back in a timely fashion. Oregon, lender partners of mine, 4 to 5 weeks, and they're still paying $1,000, $1,500 for appraisals. They're taking a long time. In California, it hasn't been as bad. I feel like I'm still getting stuff back in 14 to 17 days, but a lot of things are requiring, an extra fee to go out. So we shall see. All right, Jason. I see your backup question too, like meaning like zero out of pocket. And this is a great question. And I'm thinking you're referring to a refinance, right? And a refinance, you've got your payoff and your old loan's getting paid off for $402,000. And then your new loan, you got lender fee, perhaps. You've got appraisal, you got some title fees. Maybe you pay your tax and insurance through the mortgage. And so you got to set up an escrow account for that. So that gets rolled in. But now you've got all the stuff rolled in. And so your new loan amount's 407, 408. And some people will say, is that wise? Should I do that? Should I roll those fees into the mortgage? More often than not, I say, yeah. For a lot of people who are trying to, save themselves a few $100 a month, and a refinance makes sense for that. They don't have $5,000 or $6,000 to come out of pocket to keep their loan balance at 402. And truth be told, you refinance a big chunk of that gets rolled in. In this scenario, let's call it 6,000, and it's 2,500 in fees, and it's 3,500 in taxes and insurance payments that are being prepaid by you to fund a new escrow account. Your old escrow account that's holding your tax and insurance is going to be refunded to you within 30 days. So you're going to skip October's payment if you close today. So let's say you got a $2,200 payment and you've got $2,800 in your escrow account. Take that $5,000 that you've saved in missing a mortgage payment and got a refund from your old escrow account. Throw that back at your principal if you don't want your principal to go up. Some people just take that money and say Disneyland, which I'm fine with too. Really, if you owe 402 or 408 and you're staying in this house long term, I don't personally find it a big deal. I think that you're not going to either. And if you do, come out of pocket with $6,000 and keep the number the same, or take that refund, take that missed payment, throw it there, and then do that. But don't not refinance and go from 375 to 2875 because you're like, I don't want to add anything to the principal balance. Because like I said, there's ways to kind of do that and throw that refund money at it. Oh, some good cold water right there. Look at that. Matt the Mortgage Guy. That's Yeti. Do some business with us. I'll send you a Yeti. Maybe. Okay. For your personal investing in rental properties, what kind of properties do you like to look at? Single family, small multifamily, both of those. And really, those are the only two I can really speak to because I don't have any experience. I got friends that have done, commercial. I've got friends that have done apartment complexes. I got friends that have done mobile homes, ground up hotel. Single family, 2 to 4 unit is this stuff I have experience with, one, vicariously with investors that I work with as a mortgage broker, and two, me and my wife have single families and small multifamily holdings. I don't have anything bigger than a fourplex. So, I think there's really, Joey, like money to be made in a bunch of different areas. I've seen people find success kind of niching down, right? And here's another piece of advice. You can niche down and for the next 5 years be like, I'm single family Joey, just looking at single family, and then change that and switch that. or like you could even be, I'm 1 to 4, Joey, and look at single family, duplex, triplex, fourplexes. And then maybe 3 or 4 years from now, you graduate and say, you know what? I talked to so-and-so. I talked to so-and-so. I went into this real estate investing meetup group, and these guys are doing these apartment units that are 12 to 15, and they're too small for big investors to get involved. They're too big for, some people that don't have a lot of experience or money down to mess with. It's kind of the sweet spot in the middle where I can get some good deals. I can do some value add. I can buy something for 800,000. It's a 15 unit. I can do some rehab. I can increase rents. It's going to be worth 1.5 when I'm done. I can either exit and sell it, or I can hold it and cash flow $6,500 a month, whatever it is. There's money to be made everywhere, man. You just got to put in the work. That's the moral of the story. All right. That was the same question right there. There you go. Tell him, Joey, smash the like button. We got 31 live. I'm probably only good for an hour today. I got some family stuff to attend to. And by that, I mean, we got a new jacuzzi today, and I need to go home and get in that thing. So I think I got an hour in me, about 24 minutes left. I'll talk fast and I'll answer fast. Hey, Al, this is a great question. This is a little known fact, and I'll spill the beans with you. I know that you're a follower of Jeb Smith. I know that you're out there on the interwebs listening to the smart people in real estate talk, and so you've got more knowledge than your average bear. FHA, and you know this, even though some realtors don't know this. There's something in there that basically allows. I could write an offer with an FHA loan and say, I'm willing to pay $50,000 above the appraised value. If it comes in light, I can say, oh, I said that, but look here. This FHA rule states that I can't. Something to that effect. I got to look into it. I can't remember what exactly it is, but basically there's is it the amendatory clause? Might be the amendatory clause that basically allows you to wiggle out and say, nah, I can't, because of this, pay above appraised value. So FHA, I heard Jeb talk about it. I need to get my boy Jeb and ask him about that, because him and Josh know. I got to talk to a smarter loan officer like Josh Lewis, get the answer. I'll get back to you. Jeskel 1227. Great question. And the answer is yes. If you're 5 units or above, no matter where you're located, you are commercial. And so sometimes I've seen this too, where there's like something that is in a neighborhood of fourplexes or around a bunch of multis, and then this one just happens to have 5 units. It's commercial financing. You just can't do Fannie Freddie financing on something that's got 5 units plus. Got to be commercial. So I've got a great commercial contact. A lot of times it's like small banks or small community banks is where I found the best commercial lenders. So wherever you're at, that's probably where you want to start looking. I'm gonna confirm this for you, Joey. I don't think so. I do not think so. All right, Zachary, congrats, man. This guy bought a house and it appraised for $1,500 over. Closing next Monday. No problem. No problem, man. I'm stoked for you. I've got hope, as tough as it can be for some people. I like to share these stories and shine some light on them. People are still getting offers accepted. It's possible, folks. The dream is still alive. The American dream. There's my buddy Ryan Lundquist. You said you'd be watching. All right. Everybody's asked for Ryan Lundquist, the best appraiser out there. So I'm going to have him on. I'll ping you, Ryan. It's going to be 11th, 18th, or 25th of October. And I'm going to let you pick your poison, man. Whatever day works best for you, but it's every Monday at 6 p.m. Pacific Standard Time. So we'll have to do something that works on your schedule, because lots of folks want Ryan, including his family. So maybe he's got family plans. Maybe he's got, a realtor association that needs him to come and speak some knowledge to him. But either way, I'm looking forward to it, bro. I'll send you an email and we'll get you on here for sure. Appraisers want good clients, and the truth is so many AMCs are not good clients. Yeah, let's talk. It's going to be a good conversation because, me and Ryan are both reasonable guys. He's got a really in-depth knowledge of the appraisal industry, and, being an appraiser for as long as he has and being a high-level appraiser at that. It'll be interesting to hear his take. And my hope for this appraisal direct with UWM and the state of appraisals going forward is that it gets better for the end consumer, because ultimately, that's who all of us in business serve, is the end consumer. And right now, with some consumers having to pay $4,000 for an initial appraisal and $3,600 for a second appraisal. I literally heard that story this weekend in Vegas. It was a jumbo loan and a $1.5 million property, but still, it's wild. $7,600 for an appraisal, or the combo of two appraisals that were needed for that loan. All right. It wouldn't be a Mortgage Live without at least one question on rates. Tanner, thanks for joining. I wasn't razzing you up. I just, it's a common question, and my answer probably changes once every couple months, but that's just, I can't help but be honest with how I feel and how that changes, right? I felt that rates were headed up by the end of the year. I was 100% certain of it. And then I said, you know what? Gosh, maybe the Fed will just keep rates low forever, and they'll just continue to do what they do and buy mortgage-backed securities and never taper, and they'll stay low forever. And then last week, when the Fed just talked about beginning to taper in November, and not just beginning to taper in November, but doing it at a faster pace than a lot thought, rates took an absolute dump last week and probably went up about 0.25% on the average deal, on the average rate sheet. And for anybody who doesn't know what the taper means, they're buying a bunch of mortgage-backed securities. And when they stop the purchase of those, they don't do it from buying 120 billion to zero. They'll go 120 to 100 to 80 to 60 to 40 to 20 to zero. So it's over a period of months where their slowdown of purchases is going to cause rates to go up, because they're influencing the price by having kind of fake demand, right? Like they're buying it. It's not the open market is buying mortgage-backed securities. So that caused rates, the talk of it caused rates to go up last week. When they actually do it in November, we'll probably see a little bit more of volatility, good word for it. So I wouldn't be surprised if November, December, after that tapering actually starts, we see, if things are around 3 right now, 3.25 to 3.5 by the end of the year is probably a good guess. And then the first half of 2022, I don't think it, I don't think it moves much. I think it stays there. I think it stays in that range, 3.25 to 3.5. My best guess. Harminder is a good question. When you say skip a payment, can you explain how it works? Is payment added to the end of the mortgage? There's no payment added, but I'll give you a quick example where today, September 27th, if you closed a mortgage, the payment gets sent to old mortgage company ABC. They get paid off. They're owed $402,376. With the closing of this loan, we're also paying 4 days of interest for the last 4 days of September, 27, 28, 29, 30. And then October 1, there's no new mortgage payment. There's not going to be a mortgage payment on the new one until November 1st. November 1st, when you pay your mortgage payment, you're paying that interest for the 30 days of October. It's that interest plus principal, taxes, insurance, whatever is in your mortgage payment. But there's no payment for October 1st. So it doesn't mean that you're missing out on interest anywhere. You're not like fooling the banks and getting by. They get their interest, but there's no mortgage payment due. So whenever you close a mortgage, whether it's a purchase or refinance, you don't have a payment until the following month. Close September 27th, no October 1st, start November 1st. Close September 2nd, 25 days ago, still no October 1st, no payment until November 1st. So no matter where you close in the month, you don't have payment the month after you have it, the proceeding. And some people always ask, well, I want to close the beginning of the month then, because then I have almost 2 months until my next payment. Cool. Except for that when you close, in closing today, September 27th, you've got 4 days of interest due. And then the next payment takes care of, October interest in November. You close September 2nd. Now you've got 29 days of interest that's in your closing settlement statement, if that makes sense. So there's no trick or hack where you're, skipping out on the interest. All right, man, these are some good refinance questions. You guys are on point tonight. You guys are just like, I never know what questions will be asked. That's why this is so much fun for me. And then you guys are like mortgage university for me. Like I gotta continue to show up to class and keep myself sharp. Al is asking, does it make sense to wait and refi when prepaids are the lowest, depending on the month of the year? I guess you have to have confidence and risk tolerance that rates will be low at that time. Well, here's the thing, Al. Like you're moving shells, but you're not saving anything. And let me set it up for people who don't know what prepaids are. When you have an escrow account that pays your tax and insurance through your mortgage, you've got to set that up with prepayments, taxes and insurance. And during some months, let's say you close right now in September, you might have 9 months of prepaids on the taxes side, because there's a tax payment that's due on November 10th. Because that's due and they're about to take 6 months, the county, lenders in September want to take 9 months of prepaids. They want that 6 month payment plus 3 months of buffer. So you're like, man, my real estate taxes are $400 a month. 9 months of that is $3,600. And I'm going to pay a year of homeowners and some, 3 months of reserves on that. Like I'm going to be paying $5,000 into that prepaid section on there. Well, a couple things to think about. Your escrow payment, your escrow balance at the old lender is going to be fatter because they haven't taken that November tax payment due yet. So that's going to be a bigger refund. And it's all the same money, whether you pay it through this new, like let's say you wait until December, Al. Now there's less prepaids that you're paying on the new mortgage, but that 6 month installment got paid from your old mortgage. So the refund you get from them is lesser. It's all the same. Whether it's 9 plus 3 or 5 plus 7, it's still a dozen. My 2 cents. The end. Trent Williams. How is UWM able to close in 2 weeks given the issues with appraisals? How do they get around appraisal delays? Is it because of property inspection waivers? Mostly, if you're seeing 10-day close, 12-day close, 14-day close, a lot of times it's a waiver, or it's a purchase that's really time sensitive, and me and my clients are saying, let's do it. Let's pay $1,150 to get an appraisal rushed and get it back in 8 days. But bunch of different ways that it's done, and it's different markets, right? Like I can get an appraisal back in 10 or 11 days. I don't necessarily have to wait 5 weeks like they do in Oregon, or bribe an appraiser extra $1,000 to get it back in 3.5 weeks like they do in Nevada. So appraisal waivers, inspection waivers is probably number one way to get loans done quick, or you pay the extortion, the bribery. True story. Jacuzzi is awesome. That's why I'm only gonna be on here for 10 more minutes, but I'm gonna get through as many questions as I can. All right, guys. In 2 weeks, Ryan Lundquist, appraiser extraordinaire, SacramentoAppraisalBlog.com. He's going to be here live. Any and all questions. I will grill him with anything you guys want to hear from him. He'll do the same to me. Grill me from a lender's perspective on anything that he wants to know about, or folks that are in his circle want to know about. And it'll be a good discussion about the future of the mortgage industry, the future of appraisals, what's going on in his world, what's going on in mine, how they're going to mesh, what I see. The market, the dude is a absolute stud when it comes to market stats. So if you're in California, if you're in Northern California specifically, and you haven't checked out SacramentoAppraisalBlog.com, you have to. And we'll definitely dig into some Sacramento stats. I'm going to have you dig some of those up, Ryan, and share them with me, because truth be told, all day, every day, 150 miles an hour, I'm trying to talk to as many people as possible about mortgage. I'm trying to structure mortgages to be the most beneficial for folks' wants and needs. And sometimes I just don't have time to even slow down and look at what's going on in the market. I know what I know because of what the feedback I get from my clients. And sometimes that's like, Gary Vaynerchuk is not like looking at other things, but he's getting so much feedback from human beings that he kind of understands what's going on. That's how I feel. I'm not plugged into like, here's what the Sacramento stats say, but I am plugged into my clients saying, here's what's happened. My real estate partner saying, here's what we're seeing. Here's what's going on. So will be a very interesting conversation. I look forward to it, brother. All right. Tanisi Adams, thanks for joining. Would it make sense to cash out refi if we're looking to put that down on our first rental property, or to refi first, this would be on our primary, and then HELOC for the down instead? It's a good question. And I think that there's folks that do it both ways, where they do a cash out refinance and use that cash to buy a rental property, or they use a home equity line of credit like you talked about. And I think you're questioning kind of geared towards, well, maybe I refinance, lower my first, so I get a lower interest rate, and then the home equity line. It's really a matter of preference on which one you want to use. And my train of thought for getting into like, what would I do? That's always the best advice I think that I can give, is if I was you in your scenario, what would I do? And I would look at it, and maybe you owe $300,000 on your primary and it's worth $800,000. I would take a look at it and say, if I did a cash out refinance and I pulled out $100,000, and I thought I had some more blank paper. I like to write when I talk. For some reason, it makes me think clearer. But let's say, pull out $100,000 and you've got a 3.25% interest rate right now. You can do a cash out refinance at 2.99. That's not an offer. That's just me throwing a number out there and thinking out loud. So NMLS number 1088993. Thank you for the super chat, by the way. I appreciate that. I was going to give you a great answer anyway. Now it's really going to be great. So cash out refinance 2.99. Now your new fixed payment is $22.50 a month. Again, just throwing out a completely random number. You look at that, or you say, I'm going to refinance, lower the rate on my first, and now it's $18.50 on my first. I can go to a small community bank, which is usually where the best HELOCs are, little bank or credit union, and they're going to give me a 2.9 introductory rate. Then it's adjustable. I draw 100 from them, and my payment's going to be this much, but it's subject to change in the future because it's an adjustable rate mortgage more often than not. So you figure out, do I want that fixed payment and the cash out refinance, or do I want just my first to be fixed and then have a home equity line that's variable? Here's the determining factor for me, in my opinion, is how quick are you going to use the money? And for some people, they don't want to pull equity out of their house and just sit on that 100,000 if it might be 2 years before they buy a property. So they feel like they're paying interest on it and sitting in the bank getting 1/2 of 1% or whatever the heck you can get at, money market account or something. I prefer the stability, knowing fixed rate, can't ever move. Because what happens is the best laid plans with a home equity line sometimes turn into, well, I can't really pay that thing off. I thought I was going to be cash flowing $600 a month and chunking off payments and paying that thing off in a 3 to 4 year period. There were some repairs, there was some this, there was some that. It's really only cash flowing $225 a month. That balance turns, into 88,000 over 5 years, and then it goes to 3.9, 4.9, and that interest rate increases, and you're like, shoot, I wish I would have not took an adjustable rate HELOC. For some, right? Others have a really good plan on like, I just need the 100 now. I'm going to put the down payment. Maybe it's some sort of BRRRR where they're actually going to rehab the property and then be able to refinance and pay off the HELOC. Then they're out of it, and that's cool. But those are the things you consider. And a lot of smart people that I know that are investors prefer the cash out refinance if it's going to be something that's going to be put into action quick. If it's not going to be put into action quick, maybe you do the home equity line, because then the pro on the home equity line side is that you don't pay any interest until you draw it. So maybe you get approved for a $100,000 line, looking, nothing makes sense. Looking, nothing makes sense. You never draw it, you never pay a dime of interest. Versus cash out refinance, got $100,000 sitting in the bank, you're ready to fire. Year and a half goes by. You've been paying interest on that $100,000 for a year and a half. Those are the things you got to weigh. Hopefully that was helpful. And let me know if there's any follow-up to that. But those are some of the things that should be going through your head to do the analysis. Again, thanks for the super chat. That was cool. That's one way you can be a cool dad at age 41. Tell your kids you got a super chat. All right, where'd we go? In my state, seniors 65 and older can get a discount on their property taxes. Does this apply to every state? Where are you at, Zeta? Georgia? I can't remember where you're at, but remind me. I don't think that applies to every state. It's probably a state. It's state income tax, right? State property tax. Yeah. I don't think we have that in California. Good evening, Kimberly. Good to see you. Tanner, thanks for joining. Was my best guess on rates, man. That's all I can do. Check in next week. I'll have a new update for you. Rhonda Skeeton. Cheaper, faster, easier to use a mortgage broker. It's facts. Basilio, thanks for joining. Good to see you as always. Do you know if adding a bedroom will help with the ARV at the time of the appraisal? So you're talking about doing some sort of rehab is my guess, right? Because you're talking about ARV, the after repair value. Maybe. It's tough though, because a lot of appraisals I see, the square footage is the determining factor. So it's like, I saw your follow-up here where you're like, the square footage is the same. We're just going to add a door. I don't know if 1632.42 versus 1632.32 is going to be looked at differently. Good thing we have Ryan Lundquist coming on October 11th, and we can chat about it with an appraiser. Because I was going to try to answer it, but you know what? I don't think that this is the question you want me to answer. You want Ryan Lundquist to answer that. I don't think it's going to have a big impact on the appraised or the after repair value or the appraised value by adding a bedroom, keeping the same bones. So we shall see. We shall see what Ryan says. If he's still on, maybe he'll ping, maybe he'll weigh in. But if not, we can circle back to him on October 11th. Oh, you're in California too. Yeah, reach out for sure. Matt@mattthemortgageguy.com. It's the best way. We'll make sure we get back to you as soon as possible. If you reach out to me via email, I haven't got back today, I apologize. 4 days, mortgage broker event in Vegas, like 15-hour days of nonstop content, nonstop meetings, nonstop, you know, dinners and collabs and just the best brokers across the country. I'm like overwhelmed with mortgage knowledge. So some people I'm getting back to tomorrow. I got to be honest. I know there's a couple of great things in my inbox that my office manager kind of pinged me and put on my list, but it's going to be all right. About prepaids. I can't believe we got to the hour mark. I just realized that. I'm like, oh my gosh, it's 7:00. I'm going to jam through some of these. I appreciate the heck out of everybody that joined. And I know that we're finally up to 55 people live every Monday at 6:00. Get on here as early as you can. I've got another 10 minutes in me, I think, but we're always jamming through at least 3 or 4 dozen questions and all getting smarter and better because of it. So it's all the same, dude. Buy when prepaids are lower. The only time prepaids are lower is when there's not a property tax bill due. So like, let's say right now, property tax due is due in 6 weeks. They're going to take 9 months because 6 months of that is going out in November, right? I'm trying to think through this, Al. I would not ever time a refinance or a purchase around the time of year and what prepaid escrows are due. The end. All right. I'm get on him, Al, about the thumbs up. Tell him to smash the thumbs up button. Eddie Sam, what's up, man? Thanks for joining. Appreciate you. Yeah. I mean, you might have to replay that one because I don't know. I was going on and on about it, but there's a lot to think about it. And really, like, if I was you, I'd put it on paper and I'd put like pro, con, what it looks like, leaving your loan alone and putting on a HELOC, what it looks like doing a refinance to lower your rate and do a HELOC, what it looks like to do cash out all of it, right? And just kind of mess with that. Here's the thing. Don't overanalyze it. Some people might analyze that for the next 18 months and never purchase anything. Don't be that person either. All right. Great question. Neem H2. My husband's credit score is higher than mine. Is it okay to use his so we get a better rate? Thank you. This is a good question because people that are doing mortgages don't understand this. But if you have 2 people on a mortgage, you always use the lower of the 2 middle credit scores. Middle credit score is you've got Equifax, Experian, and TransUnion. We're pulling all 3. We're doing a mortgage. 682, 693, 705. The 693 is the middle of the 3 scores. That's your middle credit score. Then you've got another borrower that's 702, 712, 724. 712 is the middle of their 2. When you got more than one borrower, we got to use the lower, the 693. So that's what we use for qualifying you and rate and whatnot. So my best advice is if you can qualify with just one person and their income is enough to qualify, use the person with the higher credit score, right? You can't use just husband's credit and be able to use your income to qualify for the loan. If his credit and his income qualify, good. You can be, on title, but not necessarily on the loan. But if we need your income to qualify, we need you on the loan. And we're going to use the lower of the 2 credit scores. Yeah. If it's a single family, you could do 15, but you don't want to. It's a nasty loan. 20 is even not that good. 25 is the best terms. I'm a fan of Section 8. If it's done correctly and you have a good property manager, Section 8 is great because it's guaranteed. I mean, right now is a time where some people are really happy they got Section 8. People who don't are not getting paid, and people who have Section 8 is just guaranteed money being deposited. So here's the thing to think about, or the thing to voice to your property manager, or to look for in a property manager. Property manager, if doing it correctly, says to Section 8 tenant, listen there, you've got a $1,600 voucher that's paying $1,600 of this $1,700 rent. Please keep your property tidy. Please follow the rules. If not, I have to report you to Section 8. You're at risk of losing your voucher. I don't want to do that. You don't want that to happen. You're having 90% of your rent paid for from Section 8. Let's all get along. And that's what property managers that are good do. And people comply because they're getting a vast majority of their rent paid through Section 8. Under contract process, the paperwork's still okay to change FHA to conventional. I don't think that they would have a problem with you going that way. If you get accepted going conventional and then you try to flip FHA, seller might have an issue. I would talk to your lender. I would talk to your realtor. I would have them communicate it to the listing agent to make sure that everybody's communicating. I'm flipping it to conventional. I'm going to get it done still in the contract time. It's a better loan for me, a better deal for me. I qualify. Here's my lender saying so. Make sure that everyone's communicating is the best thing. All right, next couple months. That's good. Cash out refinance might make sense. I'd look at it. Yes, Jose. I told folks, if you like it, lock it. Do not gamble. And last week, rates took a big old doo-doo. So my buddy Jose, who got in a 120-day lock, is sleeping good at night. All those red candles last week where rates went to crap, Jose wasn't worried about it. He kicked Bach and just chilled. Get it? See what I did there? Kicked Bach? Oh, I crushed it right there. I should go into comedy. Your wife definitely can. And really, there's no tax implications. People think there's tax implications with gift funds. She can be a gift donor. It doesn't have to be on the loan. It's just a gift letter, wire the funds directly to title. There's rules around where it has to be reported to the IRS if it's above like $14,000 or $15,000. Check with your CPA. Find out what they say. My understanding is even if they do gift $20,000, $30,000, $40,000, it's not a taxable event. It just goes towards the maximum of 5.5 or 6 million per person that you can gift before it starts becoming like taxed. It's like some rich folks inheritance tax or something. I don't know. That's it. I'm tapping out. I got to get home for the night. It's been great. I enjoy each and every one of you that joined. Next Monday, 6 p.m. Pacific Standard Time, like I do every single Monday, mortgage Q&A. Any questions that you have that you can think of, please bring them next Monday. The following Monday after that, on October 11th, my buddy Ryan Lundquist, the best appraiser in the world, is going to answer all your appraisal questions. Me and him are going to have a great conversation. I'm sure much of you are going to join and ask things that I'm not even thinking about yet. It's going to be fun. See you then. Until next time, we going to see.